China. Now, former senior Fed official Bill Dudley says the central bank should reject the president's demands for rate cuts and not buy to pressure to fix the damage caused by his trade war. Dudley was the New York Fed president until late last year. Now, he wrote that acceding to the White House, the Fed could end up just encouraging Trump to escalate the trade war a little bit further. Joining us now from our studio in Singapore is Rob Aspen, Chief Investment Officer at MW Capital. He joins Tracy and I now. So, look, this is one of the most read articles on the Bloomberg terminal. It's an opinion piece there. Dudley makes the point, look, it could discourage further escalation of a trade war. It could reassert the Fed's independence. It could serve ammunition. One report that I read this morning from Rabo said these are staggering implications that a former Fed man would consider pushing for this for a sitting group of Fed presidents. What do you make of it?
Well, it's actually a very interesting question, and I think there's good base for him to make that comment. If you look at the U.S. economy relative to, for example, Europe and Japan, the U.S. is actually doing fairly well. The numbers are coming down, though, and I think when you look at the dilemma that the Fed has, interest rates are being cut elsewhere in Europe and are being priced in. You've now got around $19 trillion worth of government debt and corporate debt that is negative yielding. So the market is effectively pushing the Fed to cut rates. And obviously, if the Fed decided not to at the end of the day, that would as you say, create quite a dilemma, and you get quite a bit of volatility around this. I think the reality, though, is that they will cut by around 25 basis points because indirectly they have to, and their cut is already being priced in fully by the market.
Rob, it's good to see you this morning. What matters most for markets at the moment? Is it the Fed and the potential for rate cuts, or is it Trump and these ongoing tensions when it comes to trade with China?
Well, I think the real issues globally are trade. If you look at the talks and the tweets that are going around in terms of Trump saying that he's going to increase tariffs on the 1st of September and the 1st of October, and then a couple of hours later saying that he had a call with the Chinese, and then the Chinese come back saying they did not have a call. There's a lot of conflicting news flow out there, which I think creates distrust. The trade numbers are down. PMIs are down pretty much across Europe, and also declining in places like China and Japan and elsewhere, all driven by trade. So I think the trade issue is by far the biggest issue at this point in time. The one comment that I would make, though, is that trade is just the initial focus, if you like, of the tensions between China and the US, the two superpowers. Whilst there may be an agreement at some point in time, I think eventually they'll start to talk about currency manipulation. That's already been put on the table by the US, but nothing as yet has been done about that. But currency manipulation will be spoken about. And eventually there'll be talks and discussions about territorial issues, etc. So I think we're at the very early stages of an increasing level of tension between these two superpowers.
Rob, one of the areas that you mentioned there is, of course, currency manipulation. This morning, we saw a stronger fixing for the 6th day in a row, and the yuan halted its 9-day march lower. To a certain extent, what do you think that says from the PBOC? Does that ballast against the concern about Trump's flip-flops? Do they want to try and sort of show some willing?
Well, I think it's our expectation is that the CNY will weaken further, so the renminbi will weaken further against the dollar, on the back of the fact that the PBOC is and the government of China is probably going to provide liquidity and stimulus to the Chinese economy, and that will have a direct bearing, I would envisage, on the currency. What I think will happen, though, is that the currency will weaken to around 7.3, 7.5, I think the early estimates that you were talking about earlier. And then the PBOC will strengthen the currency just to get the shorts out and to punish the shorts. But eventually will continue to weaken over time. The reality is that we are in a situation where the economy globally is weak. And if you look at the numbers in Europe, for example, they're pretty much in recession. So there's a need for the Fed to cut at this point in time, and probably fiscal stimulus across Europe and China and the US.
Right, Rob, just on that note, you mentioned PMIs as well. If you take a look at this chart, pull it up on the GTV function if you're a Bloomberg client, you can see that something seems to have changed for the market, and it seems to have changed right around the time that global PMIs actually peaked in early 2018. And suddenly the U.S. stock market became much more reactive to bad news, and drawdowns in the S&P 500 became much, much bigger than they had been previously. What happens to risk assets in an environment of deteriorating economic fundamentals?
Well, risk assets such as equities are effectively driven by earnings. If you have earnings growth, then on a flat PE, you should have price increase. The two should be running in parallel. If you have weaker economic data, which drives weaker underlying earnings per share, then we would anticipate and expect that the market will price that in, and you'll have a declining stock market and declining risk assets. Likewise, if you look at corporate debt, and there's a massive bubble, obviously, within corporate debt globally, and obviously in the US and Europe as well. As corporate data weakens, driven by a weaker economy, that will feed into the potential of their ratings being cut. And there's a huge amount of debt out there which is BBB plus, or BBB, which will be potentially downgraded into junk, and that would obviously push yields much higher at the corporate level. So you have a number of different forces going on here. You have lower yields at the government level, which has obviously pulled the corporate debt down. But if you do have weaker economic data, that would then push the spreads up on the corporate side. So one has to be fairly cautious within this marketplace.
All right, Rob, hold that thought. We're going to be discussing corporate debt in just a few minutes. But before we do, let's check in on the first word headlines from around the world. For that, we turn to Selena Wang. Selena.
Thank you, Tracy. Senior officials in Iran have all but ruled out talks with the U.S. after President Trump seemed to indicate a willingness to meet. Iranian leader Hassan Rouhani said the U.S. would have to lift sanctions if there were to be any chance of negotiations. Rouhani added that Iran would be interested in solving problems reasonably, but he's not prepared to simply provide a photo op with Trump. Talks on a new coalition in Italy stumbled, with the Democratic Party and the Five Star Movement blaming each other for the threat of an early election. The harsh word suggests that, even if a deal is reached, a coalition would be hobbled by infighting. Five Star leader Luigi Di Maio said he would only support a new coalition government if the party grassroots approve, and that an online vote will take place next week. The UK government sees a chance of restarting Brexit negotiations after Boris Johnson's talks last week in Berlin and Paris. Sources say Germany and France appear to have relaxed their tone on the withdrawal agreement and the need for the so-called backstop on the Irish border. Meanwhile, the leaders of the UK opposition parties held a closed-door meeting to discuss how to block any chance of a no-deal Brexit. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Selena Wang, and this is Bloomberg.
Selena, thank you very much. Still ahead on the show. Oil extends its gains as Iran says no thanks to President Trump's overtures.
Yeah, but before that, Manus, hunting the globe for positive yields is getting harder. We take a look at what positive yields are actually made of these days. That is, if you can find them, of course. This is Bloomberg.
Economists expect Israel's central bank to hold rates at today's meeting. That'll keep it at a base rate of 0.25%, marking 5 years in which the rate has been hovering just over the zero line. But pressure is rising to intervene as the shekel has continued its run as one of the world's best performers this year. The Bank of Israel has little room to manoeuvre unless it's willing to follow some developed economies and experiment with negative borrowing costs.
Yep, still with us in Singapore is Rob Aspen, Chief Investment Officer at MW Capital Management. And of course, with negative rates also comes lower yields on a lot of different assets. You mentioned corporate bonds earlier. I have a great stat here from Bank of America Merrill Lynch saying that the vast majority of the world's positive yields now come from U.S. assets. So if you want any sort of positive yield, you're going to have to dip into the dollar market in order to get that. And of course, we've seen a lot of investors in Asia do just that. Should we be worrying about currency risk in the current environment, in addition perhaps to going down the quality curve as people try to get more positive yield?
For sure. I think there are two risks out there, as you mentioned. You've got the very strong dollar because you have money flows into US dollar assets. And then the other issue is obviously the fact that people are moving into the higher risk assets, so you have a move up the risk curve. We've actually been steadily buying sort of mid-duration, short-duration US dollar debt, but now with the 10-year at around 1.5, it's questionable what one does at this point in time. And if you look at Europe, for example, interest rates there and yields are pretty much negative across the board. So what we're trying to look at here is where can we find positive carry? Well, the US. And it's not so much a case of we're looking to hold the bond for a period of 10 years. I don't think anybody at this point in time is doing that. It's more of a trade in the expectation that the ECB and the Fed will effectively come back to the market and buy these bonds at an even better price. So that's the way we're playing it. It's a trade rather than a long-term hold.
How then, Rob, might you look at 100-year bonds? And I put that to you because Belgium, Ireland and Austria obviously have all issued 100-year paper. I know, but Sweden, we expect to come to the market with 100-year bonds as well. And Stephen Major was with the team recently, and he said, we are misinterpreting the concept of why you'd want to buy 100-year bonds. It is about the momentum that you see in terms of the capital appreciation, or the actual movement in price that you've seen, for example, in Austria. Would you go that far out? Would you buy 100-year paper from Sweden, Austria, Belgium, Ireland?
I wouldn't, to be honest. I prefer playing in the sort of 5 to 10-year range, relatively short duration. One has to be, as I say, quite tactical about this. Here's the thing, though. If you buy the $100-year paper, you're going to get potentially a negative rate of return. So people are not, as I say, buying this for protection or as a longer-term hold. They're basically buying it on the basis that the ECB will buy that bond back at a better price for them. What I would say, though, to anybody listening, is that if you do play the bond markets, it's very important, I would imagine and envisage, to also hold gold or silver as a real asset, as a hedge against any currency weakness across both the euro and the US.
I will just say Argentina's 100-year bond is telling a very, very different story to Austria's 100-year bond at the moment. So not everyone thinks the same. Just going back to the corporate bond market, we've seen spreads on triple Cs really blow out recently. Meanwhile, spreads on single Bs, the safest corner of the junk market, relatively, of course, really coming in now at a 2-year low. We seem to be getting different messages from junk bond investors. Which one of those would you be siding with at the moment?
I think both are probably right in the sense that investors are looking for yield. So they are going into the junk bond market and they find reasonable yield in the single B and the double B space. So there's a flow of funds into that area. But if you look at triple C, given the underlying economic risks, I would avoid that space altogether. So I'm not particularly positive on the junk space per se, but I'd rather be investing in junk than on triple B plus credits, for example, those that are very close to falling from investment grade back into junk.
Just very quickly, Rob, given that view, we've got this mania of recession watch in the United States in 2020 and globally. What about default rates? How does that play into your thinking as you look at this space?
Yeah, default rates are still relatively low, but obviously if you do have a weaker economy, that would push default rates higher. But I would say this, at this point in time, the US economy is not close to recession. Yes, indicators have weakened, but we still have very low levels of unemployment, and growth is still relatively positive. So with the lower cost of borrowing, I don't see that pushing the economy into a recession at this point in time on the short term. However, it does obviously depend on trade talks and where we go with that.
All right, Rob Aspen, we're going to have to leave it there. That's Rob Aspen, the Chief Investment Officer at MW Capital Management. Thanks so much for being with Manus and myself. Now, up next, investors get a whiff of a potential merger